Hey everyone, and welcome back to Daily Market Narrative for 20th August, where we try to make sense of the financial chaos so you don't have to. Today's big story, or rather the ongoing saga, is this epic battle between inflation fears and the Federal Reserve's monetary policy. It's like a never-ending sequel where the market's desperately trying to figure out if the Fed will keep slamming the brakes on or ease up a bit. We're all glued to inflation data, hoping for a sign that prices are cooling down, which would, in theory, give the Fed less reason to keep hiking rates and potentially avoid a full-blown economic recession. But then, bam! Any whiff of stubborn inflation, and we're back to fearing higher rates, slower growth, and, you guessed it, the dreaded earnings hit. And let's not forget the tech sector, the darling of the market. When Nvidia and its pals are soaring, everyone feels great. But when they stumble, the whole market seems to trip over its own feet. It's a real delicate dance, folks, with interest rate expectations and the elusive soft landing being the main dance partners. Now, let's dive into the nitty-gritty of what's actually happening on the charts, because apparently a few squiggly lines can dictate the fate of trillions of dollars. So, the big picture for the SPY, that ETF that tracks the S&P 500, is that it's generally in an uptrend on the larger time frames. That's the good news, the glass-half-full crowd's favorite part. But if you zoom in on the daily chart, things get a bit more nuanced. It looks like the SPY is currently trying to find its footing, attempting to set a higher low before it can even think about grinding its way up to some mythical 660s. However, and this is where the cautionary tales come in, if those key daily support levels, specifically around the 640 and 620 marks, decide to break, well, then, as the chartists say, look out below. It's basically saying uptrend is nice, but don't get too comfortable if these specific numbers give way. All right, let's switch gears to the news that's actually making waves. First up, buzz in, tech-led slide cracks summer calm in stocks. Apparently, our tech giants decided to have a bit of a tumble, led by Nvidia, which shed a respectable 3.5%. This little dip has shaken up the summer calm, reminding us how much this market hangs on the shoulders of a few big growth companies. The Nasdaq 100 had its second worst drop since April. However, not everyone was crying into their spreadsheets. Some sectors, like big-box retailers, actually saw gains, and Intel got a nice bump on news that the US is finalizing a stake in the company. The takeaway? This tech slump might mean more volatility and a potential shift away from those high-flying growth stocks. Keep an eye on whether this is a blip or the start of something bigger. Next, we've got Powell's last stand at Jackson Hole. Our very own Federal Reserve Chair, Jerome Powell, is about to step up to the mic at the Jackson Hole Economics Symposium. This is a big deal, potentially a defining moment for his tenure, especially with his term wrapping up and some critics breathing down his neck. He might use this stage to shore up his legacy and defend the Fed's independence. The symposium's theme is about the structural forces shaking up the labor market and the economy, which is a fancy way of saying it's complicated. Powell's challenge? Balancing price stability with maximum employment in this ever-changing landscape. The market impact? Massive. Whatever Powell says will be dissected for clues about future interest rates. So, get ready for some potential fireworks depending on whether he sounds more like a hawk or a dove. Moving on to some more colorful news. Mart shares soar 11% as CEO announces new Mini Labubu. Yes, you heard that right. Chinese toy maker Mart saw its shares jump to their highest point since its IPO because the CEO announced a new little doll, the Mini Labubu. Apparently, this doll is a big deal. The CEO is also feeling optimistic, projecting sales to hit 30 billion yuan, and they've already reported some seriously impressive first-half results, with revenue up over 200% and net income leaping almost 400%. This surge shows a lot of investor faith in their ability to capitalize on collectible trends. So, if you're into collectible toys, this might be a sign that the market for them is booming. Now for a blast from the past, or at least a resurgence of a past trend. The SPAC King mounts a comeback as investors embrace risk. Billionaire Chamath Palihapitiya, famously known as the SPAC King, is reportedly gearing up to launch a new special-purpose acquisition company, looking to raise a cool $250 million. This comeback kid move happens as investors seem to be feeling a bit more adventurous and ready to take on riskier ventures. His new entity, American Exceptionalism Acquisition Corp. A, is set to list on the NYSE. Now, let's remember, some of Palapatia's previous SPACs haven't exactly been smooth sailing for investors, so this is definitely one to watch. It signals a potential renewed appetite for SPACs, which could mean more companies going public through this route. Over to the UK, where things are heating up, literally. UK inflation hits 3.8% in July, highest level in 18 months. UK inflation clocked in at 3.8% in July, the highest it's been in a year and a half, and it beat expectations. The culprits? Rising transportation costs, especially airfares, and a noticeable jump in food prices. The Bank of England had already warned inflation could hit 4%, and it looks like they might be right on track. The impact here is pretty straightforward. More inflation, especially in essentials like food, could mean the Bank of England either keep interest rates higher for longer or delay any expected rate cuts. This will put more pressure on household budgets and could put a damper on consumer spending there. In a bit of political intrigue, we have Trump embarks on a $104 million bond buying spree while in office. Apparently, Donald Trump has been busy buying bonds to the tune of over $103 million since returning to office. These investments span municipal bonds and corporate debt from companies like Qualcomm and Meta Platforms. The details came out via a White House document on his financial activities. The market impact here is less about the specific investments and more about the optics and potential questions about conflicts of interest. It's a reminder that political figures' financial dealings can sometimes raise eyebrows and lead to increased scrutiny. Back to the U.S. market's mood, we saw U.S. stocks fall as investors parse retail earnings await Powell. Stocks opened lower as investors tried to make sense of retail earnings, like Home Depot's, and braced themselves for Fed Chair Powell's speech at Jackson Hole. The S&P 500 dipped slightly, led by energy and communication services, while the Nasdaq 100 also slipped. Essentially, the market's on edge, waiting for any hints from Powell about the future path of interest rates. This shows a general sense of caution as we approach these key events. And finally, a bit of trade news that could ripple through the economy. Trump expands 50% steel and aluminum tariffs to include 407 additional product types. The Trump administration is broadening those 50% tariffs on steel and aluminum to cover a whopping 407 more product categories. We're talking about things like fire extinguishers, machinery, construction materials, and specialty chemicals. The stated goal is to prevent tariff evasion and boost U.S. industries, but the exact list has caused some confusion. The market impact? Businesses that rely on these imported goods might see increased costs, potentially leading to higher prices for consumers and disruptions in supply chains. Plus, there's always the risk of retaliatory tariffs from other countries. Now for a peek at our crystal ball, or rather the economic calendar, to see what's coming up that could shake things loose. We've got a few mortgage-related reports from the MBA, which will give us a snapshot of housing market activity and borrowing costs. Then there are the usual EIA oil and gasoline stock changes, always good for a bit of volatility in energy markets. The big players on the calendar are the speeches from Fed officials like Fed Waller and Fed Bostic. What they say can certainly move markets. We'll also have some important Treasury options for 17-week bills and 20-year bonds, which are always watched for signs of demand. And, of course, the big one, the FOMC minutes. These minutes from the last Federal Open Market Committee meeting are where we dig deep into the Fed's internal discussions about monetary policy. Any hints of a shift in thinking could be market movers, so lots to keep an eye on, as always. All right, folks, that's a wrap for today. It's been a week of tech wobbles, inflation worries, and the ever-present anticipation of what the Fed might do next. Remember, the market's a complex beast, and sometimes the most important thing is just to stay informed and not get too caught up in the daily noise. We'll be back tomorrow with more narratives to unpack. Until then, stay invested, stay curious, and try not to let those squiggly lines give you too much heartburn. See you tomorrow.